17 minutes away from the opening bell here in New York City. Futures just firming up after a softer morning throughout the whole morning here in New York. We're up by just over 1/10% on S&P 500 futures. One headwind, potentially though, well, markets bracing for what could be potential tariffs on steel and aluminum imports, and what could be one of President Donald Trump's most aggressive trade actions since taking office. The president tweeting earlier this morning, our steel and aluminum industries and many others have been decimated by decades of unfair trade and bad policy with countries from around the world. We must not let our country, companies and workers be taken advantage of any longer. We want free, fair and smart trade. Still with us, Ward McCarthy at Jefferies, Steve Wood of Russell Investments, Brian Niconuvine and Kathy Jones of Charles Schwab. Ward, is this the starting gun for potentially what everyone feared about 18 months ago, which was the beginning of a trade war?
Well, it's the threat of a trade war for sure. But when you're dealing with President Trump, you can never really tell if what he's saying what he thinks or if he's trying to take a sufficiently severe position that it will, in the long run, get to a place that makes him somewhat happier. I mean, he's been advised by his own advisors, we don't want tariffs. I think if we listen to anyone on this table, they're going to say the same
Depends which
thing.
advisor he speaks to. If it's Peter Navarro, he gets told one thing. If it's Gary Cohn, he gets told another, doesn't he?
Well, that's true as well. But he tends to take an extreme position, and then it gets moderated over a period of time. I think what he's trying to do is to just get more things on the table with China so that we can improve our trade deal from the U.S. standpoint with China and lower the size of our trade deficit. I think that's what his objective is.
Brian, Nick, is this something that markets need to be concerned about? Because 18 months ago they were conditioned not to care for a long, long time. Do they need to start thinking again?
I think this was always one of the risks of the Trump presidency in general. I think 2018, because we weren't going to see that major top-line legislation coming out of Congress. So these were the types of things we might have expected to see. It's encouraging this morning that real disposable incomes for U.S. households went up, savings rate went up, because people may need to be spending some of that money on goods that include steel and aluminum if those prices do indeed go up.
I want to cross over to Bloomberg's Kevin Cirilli on Capitol Hill, our chief Washington correspondent. Kevin, what do we know so far in our reporting, and what are we looking for later?
Well, busy day here on Capitol Hill and at the White House. President Trump expected to unveil at 11 o'clock this morning new tariffs on steel imports heading into the end of NAFTA negotiations. We should quickly note that Canada is the top supplier of steel to the United States. Now, of course, domestically speaking, this might play well in Rust Belt states like Ohio and Pennsylvania, which President Trump won. But internationally, the fallout could be intense, particularly from the European Union, which has threatened to file complaints with the World Trade Organization, the Chinese, and also South Korea. South Korea already suggesting that they might shift their business to Southeast Asia or Russia.
Here's the problem, Steve Wood. To Kevin's point, bring up that chart again. We can put it up on the screen. This isn't just going to be a tariff potentially on China. It's going to be a tariff potentially against the EU, Brazil, Mexico, Canada. How does the rest of the world respond to this?
I think they will respond probably quicker than we would suspect, and probably not well. So I think I agree with perhaps the negotiation strategy. The art of the deal is, go high or go very low and take a compromise in the middle, which I hope would be the case. Yeah. And I travel a fair bit. I was in Canada the week before last, so NAFTA is very clearly on the front of their agenda. The auto, as well as soft lumber and the commodities. Yeah. So this is going to be something which is going to create some shorter-term destabilization in the U.S. economy, and it will not be good for growth, I think. And the inflationary numbers could also suffer from this as well.
Kevin, you mentioned the international response. The timing of this is insane. You're going to have one of the economic advisors, the top economic advisor to President Xi Jinping, meeting with the likes of Gary Cohn over in Washington, D.C. today. How is that meeting set to go? What's on the agenda?
Okay, we're just kind of watching it right now in the pre-market, what they're both doing. I got the last 100 days of Apple and Chevron up, the two that I'm invested in. So that way we can look and see how they're doing. Overall, the MACD is doing good. Histogram doing decent, like a little bit of a struggle here for Chevron just because of what happened the last 2 days. Here the histogram, because of what happened, has gone down a little bit. Stochastic on both are down because of all the sellers from the last 2 days. So it's just a little bit down on that, but that's okay. everything's still looking great.
A new intensity to these final rounds of negotiations.
Bloomberg's Kevin Surley, always great to catch up with you. Kathy Jones, the situation here is bizarre. Let's just say the Fed chairman gets asked about this today. As we understand, the new style is to tell us what you think. What's he going to think of this?
Well, I doubt that he's very much in favor of it. The big fear is that not only, this tension builds up, but we get retaliation, right? And so they've already talked about retaliation in the agricultural sector. Not good for the U.S. China's a huge buyer of our agricultural goods, so it's going to hurt the farm sector. It's going to raise inflation domestically. So there's not a great outcome. I mean, tariffs rarely work. It's usually not a great outcome, and I would assume that that's what Powell says.
The trade of 2017 was EMFX rips and fade. Any concern about any of this stuff whatsoever? Have we reached an inflection point as far as that's concerned?
Oh, we think so. We're underweight EM bonds. I think we might be the only ones underweight EM bonds in the world right now. But,
That's a worry.
This penny stock is up 25%, 2.7.
Paid for the risks, and as we get into 2018, further
Let's
into
find out
these
why.
concerns about the Fed tightening, global central bank liquidity declining, and now trade tensions, that's not a good combination for the EM.
Steve Wood, how do you remain constructive around EM with this as the backdrop today?
Well, I think you look at the dollar first. So the dollar strengthening into this is not terribly likely. So you
It had really good results on the study.
So that is one ameliorating factor, we would think. But also, if you look at longer term, as the U.S. economic cycle ages and decelerates, which it is doing, the European is younger, as is the new Chinese growth cycle.
It was up a lot more earlier.
As well. So I don't know that it's a broad statement, but in credit space, I think active also is really going to shine in global, not only equities but fixed income as well. So I think there is still some valuation and cycle opportunities in EM.
Brian, final question to you. A lot of this predicated on the idea that a weaker dollar.
This looks like it could be a good penny stock.
So I think that long term we are in for further dollar decline, just given
Getting
that we're
ready
so
to
much
go
further
up
advanced in the
here.
cycle. But this year, even before the news about the tariffs, I thought this could be we could see a pause in the dollar with more Fed rate hikes, with maybe an ECB that doesn't need to be as hawkish or as quick in getting out of its QE program and start hiking rates on its own.
Yeah.
So I thought maybe a pause in the dollar this year in the context of a broader multi-year decline.
Brian Nick of Nuveen and Kathy Jones of Charles Schwab, and alongside Steve Wood of Russell Investments, sticking with me. A special thank you to Walt McCarthy of Jefferies. Coming up, some of the biggest movers ahead of the Open. That's next in our morning calls. In the markets, we turn higher. Futures looking a little bit firmer here. 9 minutes away from the Open, up about 1/10 of 1% on the S&P. Dow futures positive 0.08%. From New York, you're watching Bloomberg.
Yeah, just this penny stock right here. It's looking pretty good though. 5 minute out of the free market. Looks like it wants to go down a little bit more. It's kind of consolidating though, between here and here.
7 minutes away from the cash open in New York City, with futures turning that little bit higher after being lower throughout the morning. We're positive by around about a tenth of 1%. I do want to get you some morning calls this morning. A look at some of the big movers on the back of analyst recommendations. First up, we begin with UBS upgrading Wendy's to neutral from a sell, boosting its price target up to $17 a share. The analyst signing improvements in free cash flow targets. Next, Piper Jaffray reiterating its underweight rating on Valiant, slashing its price target down to $10 a share. The analyst telling investors that Valiant's management is over-projecting an overly rosy long-term view. And finally, WPP getting absolutely battered, suffering its biggest drop since 1998 after the advertising giant slashed its profit outlook and predicted another year of no growth. Still with me, Steve Wood of Russell Investments, Brian Nick of Nuveen, and Kathy Jones of Charles Schwab. Steve Wood, just taking WP as an example this morning. WPP, the world's biggest advertising agency and some of the world's biggest companies, cutting back ad spend at a time when the economy is meant to be doing well. What's the story there?
I think the story is, active management matters. It is an opportunity to find value in a market as expensive as the United States is, for example. But I think people want to stay on their toes.
We got about another 4 minutes to pre-market. Watch Apple there.
So I think with a name like that, surprises can happen in this environment. Volatility is going to be more like 17 to 25. Vol's not going to be 8 to 9. So I think we can see more stories like this, and I think getting your long-term strategy right is going to be more important.
Kathy, for someone involved in credit, is that still the story of the day, cost cutting?
Not much is really going on besides what we've have up. Just that one penny stock. Apple trying to climb up more. I guess it had dropped at one point today to 177.
The question, are we going to see more capital spending from some of these big companies? I know this is a very slim portion of the overall spend if you just look at ad spend, but it's just an example of what's not happening in the global economy right now.
Yeah, the irony is that this is built into the new tax reform law, is that there's incentive for companies to do this right now, starting this year. It was already, if you look at things like equipment, it was already a relatively strong part of the economic growth that we saw in 2017, but we should continue to see this, and this is really the upside scenario for the economy, right? We know the consumer is relatively in good shape, global growth is strong, we're going to be getting a ton of fiscal stimulus from the federal government. Is that private investment, is that capital spending going to kick into higher gear and get us closer to that 3-4%? I think my expectation is we're going to be, somewhere sub 3% for growth this year, even if capital spending incrementally increases.
Yeah, so I'm just watching. It's nothing much is going.
Up next, in the markets right now, we're about 4 minutes away from the opening bell, with futures still firmer, up a tenth of 1% compared to the weakness we saw earlier in the session and following 2 straight days of steep losses on the S&P 500. The cash open up next. This is Bloomberg.
Best Buy is up 2%. Okay, we got about a minute and a half before the market opens. So, we'll see. I like this penny stock so far. Alright, so the market just barely opened, so that's good. Let's see how it does. Apple, a little struggle right now. Chevron, a little bit of a struggle. Even the penny stock is struggling a little bit. Chevron just went green a little bit. More buyers on Chevron at the 83.
Snapping a 10-month winning streak on the S&P 500 and coming off the back of 2 straight days of steep declines. Futures dead flat going into the cash open. Dow futures down by almost 1/10 of 1%. S&P 500 futures going absolutely nowhere. As we wait for the Chairman Powell.
Okay, Chevron's trying to climb. Apple's trying to climb. So we're both positive. I'm watching this penny stock for a second longer. Okay, Apple back in the 179s. That's good. With me around the table, Steve Wood of Russell Investments, Brian Nick of Nuveen, and Kathy Jones of Charles Schwab. Guys, I want to put some moving parts together. We thought we were going to have a really dovish Federal Reserve chair. He's going to introduce some two-way risk into that equation on Tuesday. We thought the tax bill was going to be a big tailwind for growth and we wouldn't have the big headwinds we expected 18 months ago, and now we're talking about tariffs. Kathy, put those 3 things together for me. What does that all mean for markets? Apple is really trying to get its gains back here from yesterday's loss. This is good that it started up here. Looks like here it's going to try to climb.
And I think that this is a normal environment. So we're getting normalization not only in rates, but we're getting normalization in volatility. So we would advise clients this is what normal looks like. And being in this environment is something they should expect to continue through the end of this year. But, you know, the optics on the tariffs are very large, but it's not it's certain that the fundamentals are going to be as impacted.
We don't have them yet.
We don't have them yet. My understanding is that the president wants to be a little bit higher in terms of tariff rates than even Mr. Ross. So those would be...
Well, red right now on the penny stock. So it's starting to struggle. Is it going to break its day low right here?
The tax cut is going to be impactful. But we're going to get that in 2018. The Fed policy, however, we come back to that. That is going to be a year and a half in terms of the legs. So when we start talking 2 years from now, that's an opportunity, we think, to benefit from rebalance.
Chevron doing pretty well, as well as Apple. They're both doing good. So I'm happy about those two.
Than say upstream. The steel producers in the United States are like this. Auto manufacturing's like that. Why are we doing this?
I do think it is politics. It's sort of playing to the base, right? Changing the narrative in Washington.
Okay, so that penny stock did break down.
The president's been very consistent on, well before he went into politics, was he thought that China and other countries were sort of eating our lunch on trade.
Apple kind of struggling right now.
From an economic standpoint, it's not that this is going to sort of, wreck the I think, pretty good growth story we're going to get this year anyway.
Right here, struggling.
Negotiations if you start slapping tariffs on one of the biggest imports we're bringing in from Canada, which is involved in NAFTA, obviously. So, what does the retaliation look like, and how does it impact growth? Probably not this year, but 2019 is starting to look like a more problematic year. More Fed rate hikes, stimulus starting to wear off, some of the impact of the tax cuts going up, and then maybe the full felt impact of a trade war.
Well, speaking of the autos, we can get some more auto sales for you here in the United States. I want to cross over.
Okay, that's stochastic on the Apple right here. You can see that it curved, and it looks like it wants to cross here to go down. Histogram still trying to work its way up. It's kind of consolidating itself right here. The MACD, it's trying to still climb up, so that's a positive on there.
Taylor Riggs, solid work. Back up with you a little bit later, about 3 minutes into the session. Equities firmer by about 0.2% on the S&P 500, up by 0.16 on the Dow. Let's get you some movers and cross over to Bloomberg's Julie Hyman. Jules.
Well, it looks like tech, at least out of the gate this morning, is the leader once again, John. Salesforce.com out with its earnings Those shares up 4.5% in the wake of that. It's a forecast for 2019, fiscal 2019, topping estimates. It's seeing continued growth in its cloud
So
businesses.
here's the penny stock who wants to move.
Potential drawback that might be limiting gains otherwise.
If you look here at the volume though, notice how the volume keeps going down.
Tech is rising. Advertising continues to struggle. The UK-based advertising giant, which also trades in the US WPP, that stock is plunging. It's its worst session in 20 years. The company slashing its profit outlook and also.
All right, then here is Apple's struggle, and Chevron has gone down 20 cents in the last couple seconds as well. So.
Its U.S. rivals, Interpublic and Omnicom, are also trading lower. And the other industry we're watching today is retail, as we continue to get these retail earnings here at the end of the earnings season. Best Buy doing much better than expected, surprising investors here. Comparable sales there up 9%, 2.9% is what analysts had estimated. So Best Buy holding up well against the likes of Amazon. Kohl's, its numbers beating estimates, earnings per share ahead of estimates. Comp sales basically in line, rising 6.3%, but the shares are trading lower here by 4.5%. Excuse me. It looks like, actually, I'm not sure why the shares are down, so I'll keep looking into that.
Looks like the Dow Jones is going down a little bit.
There are winners and losers in retail. It's not sort of monolithic here. L Brands coming out with a first quarter forecast that is below estimates. There, I'm quite sure why the stock is down 10%, but I'll do a little more digging on Kohl's, John.
Down a solid 10% as well. Julie Hyman, thank you very much.
It's
For more
going to
detail,
cross.
joined on the phone now by Chuck Grum, Gordon Haskett, Senior Research Analyst. Chuck, where are the winners in retail right now?
Well, I mean, pretty much almost across the board, we've seen strength at a number of players. I think the winner here is really just the top line trends across retail. And then you got to kind of dissect, who's done well on the gross profit margin and inventory line. And you spoke about Kohl's earlier. Kohl's had a phenomenal fourth quarter on the top line. Their gross margin, complexion, and inventory.
Here you see the stochastic though, it just hit right below the 20. So it's interesting because it can bounce back up soon.
Chuck, in terms of the losers, Walmart, the big winner through 2017, delivered a fantastic year. And then we start to see some signs of weakness against the likes of Amazon and e-commerce. What's your read on what's going on there?
I think it's got a game of expectations. I mean, Walmart had 3 straight quarters of north of 50% digital growth, and clearly in the fourth quarter that number came in a little bit softer, so there's some confusion on that front. There's a little bit of disappointment on the gross profit margin line. Stock had a phenomenal run in 2017. It's pulled back to a level that we like it here. We continue to like their strategy. We don't think that their results in the fourth quarter really change the narrative around Walmart. It may push out the narrative to some degree, but we think they're focused on the right things, integrating their brick and mortar business with their digital business. We like where they're headed. It's pulled back, a little bit disappointing.
So Apple just right here went red.
In a consolidation mode.
The gun debate continues. A whole host of companies responding to the school shooting over in Parkland, Florida, just 2 weeks ago. Just moments ago, another company weighing in. I want to cross over to Taylor Riggs for the news.
John, this time Kroger, which is the largest
Still didn't hold it though. That's more of a little bit longer term. Chevron kind of struggling a little bit. It's okay.
Fred Meyer chains, they carry general merchandise and groceries, no longer selling firearms and ammunition to buyers.
So the last 2 days the market has kind of struggled, and today it's going to struggle a little bit again.
Of course, yesterday, 2 of the nation's leading gun sellers, I'm talking about Walmart and Dick's Sporting Goods, also took steps to limit their sales of
So
firearms.
the Dow is actually going down pretty fast.
A bit of a PR issue for the likes of Walmart. How do you expect them to navigate it, and is this it?
And if you're wondering, for those who are new here, is why I'm not doing anything yet, is I always wait till the 45-minute mark.
And it's really just a matter of choice of the management teams what they're going to do going forward.
Chuck Grum of Gordon Haskett, great to catch up with you, sir. Thank you very much. Still with me around the table is Kathy Jones of Charles Schwab, Brian, Nick of Nuveen, and Steve Wood.
For both Chevron and Apple, I am confident that they will go up. The MACD tells me so.
I think the saving dynamic is probably
still on its way back up.
Mike McKee had a great chart on saving versus
So
consumer spending.
I'm fine with
And we
that.
found that out in 2008, the original stimulus.
Just
was
gotta
in
hold
the
on a little longer.
And that money was saved. And this is part of the puzzle that the Fed has been trying to solve
Back in the
for some time now. Is that
trying to get
deceleration
back into the
of investment. So I
178s.
think that will be
Here
part of it.
looks like it may cross soon with the stochastic, so that's good.
Continue to do well. I think the economy looks good in the U.S. Our issue continues to be that valuations were very, very high coming
Here, this
into
penny stock is
2017,
struggling.
Very, very high coming into 2018. So valuations ultimately matter. I think the consumer provides some boost for 2018, but that could come a little bit off the boil next year. Kathy?
Yeah,
Chevron back in the 112, so that's good.
Very high, and consumer spending probably get a little bit of a boost early on, but already, consumer debt levels have climbed very high.
Let's
So
see
it's not like
here.
they've been sitting on their hands, and the
Amazon
savings rates have been coming down over the past year until just recently.
kind of consolidating right now.
Much more leverage consumers are going to be willing to take on.
And Brian, Nick, finally to you.
Prefer to see the savings rate climb a little bit during an expansion rather than having to sort of snap back up during a recession. So that's not a bad thing. 2.4% is quite low for U.S. household savings. In terms of playing this in the markets, I think one of the big differentiators last year with retail was how global is your customer base, because the savings rate is not going up in much of the rest of the world or earlier in the cycle.
Looks like today may be a short selling day though.
You see those wages come up in countries that have been not growing as fast as the U.S. for a long time. So if you have a global reach, what's happening with the month-to-month changes in the savings rate in the U.S. and how much of the tax cut people spend is not as big a deal to your bottom line.
Brian, Nick and Nuveen, been great to catch up with you. To Steve Wood of Russell, thank you very much. And as always, to Kathy Jones of Schwab, thank you very much. In the markets then, about 10 minutes into the session, a story as follows. Equity softer here after 2 days of weakness. You can make it 3 in the early part of the session. We're down by 0.25% on the S&P 500, off by 1/3 on the Dow. From New York City, you're watching Bloomberg.
Kind of low on the stochastic right here. Makes me a little worried about short selling right now, but still wants to go down. That's why we wait another 2.5 minutes. Yeah, I don't like Fashion Group. Too low volume right now. 8 million shares, and it went down on this one. Looks like we're gonna see Amazon go back in the 1400s. Got another 1 minute, 12 seconds. We'll see if that stochastic likes to wants to come back up, or if we're gonna short sell it.
Bloomberg Markets The Open. I'm Kaylee Lyons here in the Hewlett-Packard Enterprise Green Room. Coming up later today on Bloomberg Markets Balance of Power, Robert Reich, former U.S. Labor Secretary.
25 seconds.
About 13 minutes into the session here in the United States. In New York, the story as follows for equities. We are down by 0.6% on the Dow, following 2 days of losses on the S&P 500, softer by 4. In the bond market, the story looks a little something like this.
3 seconds.
Yields lower by 2 basis points to 284. And here's a novelty for you. Over the last couple of days, the dollar strength sticks. Euro dollar coming back to 120.169. Dollar yen south of 107 at 106.88. Up by 0.2%. Big story here in the United States in the last 24 hours. Spotify filing to go public on the New York Stock Exchange, but opting for an unusual strategy, planning to list shares directly on the exchange rather than relying on underwriters. The music streaming service will also allow investors to buy existing shares of the company that have so far been privately held rather than issuing new shares. Joining us now is Mark Lehman. He is JMP Securities President, and Santosh Rao, Manhattan Venture Partners, Head of Research.
See how the stochastic right here and here are both so low? It's just scary to short sell right there when it's so low on that. Tells me it wants to climb up a little bit.
Very unusual IPO though, in the sense that if you're not selling, other people might not be either, and then I've got no idea how big this IPO is going to be. What do you think of the strategy to do it this way?
Yeah, I think that's the mystery, that's the plus and the minus of it. So we don't know exactly how many shares will come to market. But
see, now it's kind of consolidating right here.
Sellers, they will be buyers. So
no, 1 minute.
In the music industry, you have to believe in the B2C companies.
Chevron doing pretty well. Apple struggling a little bit.
Bearish guys as well, bearish investors. But overall, I think I expect a good IPO.
See, there's a little rise now on there.
This is specific to Spotify. Normally, it's kind of risky to do this thing, but I think this, for all practical purposes, Spotify has been a public company. We know the financials. There's a solid secondary market going on. So the price discovery may not be as difficult as we think that we usually have for it.
Mark Lehman, I want to bring you into the conversation of JMP Securities. What's your view on the actual approach to this IPO of Spotify?
Well, obviously it's unique and it's specific to the company. And
Apple trying to go green.
Kind of needs to take place given some of the dynamics of where the capital structure of the company is. So it's not too surprising, and it's a little different. I think over time you'll see some secondary shares come to the market, sometimes in blocks and other places. But it's very unique to the company. I don't think it tells you anything about the overall health of the tech IPO market, which we think is quite strong at JMP. And you're going to start to see some real examples of that this month and beyond. Given the backlog that we
here you can see the histogram climbing, stochastic trying to climb here and here. Histogram on a 5 minute though, not yet. So basically, right now I want the 1 minute and the 5 minute to be telling me the exact same thing. Otherwise I don't want to go in.
The story of them doing really, really well, but if you think about the difference between them and Netflix, they've got to hand over, I think, 70% of sales to the music rights holders because they don't produce any of their own content. So maybe the differentiating factor is that Netflix can do their own content and Spotify can't. Is that a limitation?
It is in the near term because they're limited by their contracts with the music labels to do their own content, their own programming. But down the road, I'm sure they will work out some kind of arrangement with the labels and the publishers. So I think that's a limiting factor. They keep 30 cents on a dollar every time. So I think that's a big, but they will work around it. It's been working well for them. The artists are happy, the labels are happy. So I think in the long run, I think they'll work out a constructive arrangement.
Okay, Chevron getting closer and closer to 113, so 29 cents away. It's good. Apple is green again, trying to climb.
So Mark, is that a difficulty, a headwind as you look to push forward the view on this company?
Well, I think the analogy to Netflix is a difficult one, and you brought that out. I mean, Netflix is kind of a have-to-have. Spotify sounds to me sort of a want-to-have. I mean, I'll use my personal family as an example. We are an Apple Music family. We pay our $14.99 a month. We sent a text around to the family and said, who wants to switch to Spotify? And we kind of had a 3-2 vote. We didn't have a 5-0. Netflix, if we got rid of, I'd probably be taken out of the family. So I think there's a large difference between the two, and they've got to prove that that you want to own the service. And
a little struggle right here.
Have to own it. And I think it's well run. They got some great insiders. They got some great investors right now who are on the board, and I think they're doing the right thing for the listing. But they've got to prove that you have to have.
Good thing is if we do Amazon right, and we can make some good money off of it.
Spotify has a different business model. They have a streaming service that is the majority of their revenues,
It's growing very fast, so I think it's growing at 40%, the streaming, the premium subscribers. But I think that's the mistake that Pandora made, which is an ad-based model. So Spotify has the benefit of both. They have a subscription model and an ad-based model, and it's growing on both ends. So I think in that sense, the hybrid model works very well. They've proved that.
Marlena, just in terms of IPOs full stop, the story so far has been a lot of this growth has been trapped in private markets. It just isn't coming public. This is almost a rare opportunity for a tech company that is actually going public. Any signs, Mark, from the study, the work, research you've been doing, that we're going to see more of this?
Yeah, we think so.
This is good that it was the second green right there.
Friday, talk about their IPO. That's a billion-dollar revenue company that have a very, very large market. And
But it is struggling.
The consumers know this company. You're going to see more and more of that. Just look 2017 versus 18. So currently, over half the deals in Q1 that are filed are tech companies. Last year, that was 15%. You're going to start to see more and more of these unicorns start to flow into the public markets, and the investors and the consumers are going to get a chance to look at these. And I think that's a really good trend. And I think you're right. A lot of the market cap has been trapped privately.
Slowly trying to curve on the 5-minute. Here it is trying to cross right now. Stochastic went kind of high here though. Pretty fast. That was a pretty fast up right there. Stochastic. It is trying to climb up here on stochastic too, so that's a good sign. It's a little curvy now. It did cross.
I think this is significant, and this IPO is significant. It might open the floodgate wider.
It's struggling.
We need B2C companies to come in.
Maybe a fake cross.
If they do very well, which we hope they will, I think it's going to open up the floodgate for a lot of private companies waiting in the wings. You have the the Lyfts and the Ubers and the other ones waiting in the pipeline. So I think this is a good tell on what's to come in the future.
Santosh Rao, been great to have you in. We're going to have to get you back very, very soon. Of Manhattan Venture Partners and to Mark Lehman of JMP Securities over in San Francisco. Breaking news here in the United States, the auto sales keep coming through. Let's get across to Taylor Riggs. Taylor.
Hey, John, yeah, we have Ford now coming out with their light sales in February, missing estimates as well. Sales off about 6.8%. Most analysts had expected a drop of 6%. Trucks up 1.2%. That's interesting, but SUVs off 12.3%. So again, you have Ford and GM coming in a little bit worse than expected. Fiat better. Overall, Ford continuing those worsening sales in February, off 6.8% in this month. John.
Taylor Riggs, nice work on the auto sales. Thank you very much. About 21 minutes into the session, a story in the markets worldwide looks like this.
I'm watching Ford. They missed estimates.
Down by about a third of 1% on the Dow, off by almost a quarter of 1% on the S&P 500. In the bond market, as we wait for Chairman Powell, Treasury's bid yields lower by 3 basis points to 284, and the dollar stronger. It's day 2 for Chair Powell.
But it's not going down too much more. Right here. See here with the MACD now, we're staying right by each other, and here it's trying to break up a little bit more in the MACD, but it's still struggling. So that's why we've been waiting this whole time. See here under the 100-day chart, the MACD, histogram, and stochastic is saying that Amazon's going to go down for just a little bit. So here's that stochastic. Look how fast I went down. With only 3 here. But really with the 2 after it crossed.
This is Bloomberg Markets, the Open. I'm Jonathan Ferro. It's time now for the trading diary. What you need to be watching throughout the remainder of the week. At the top of the hour, it's round 2 for Fed Chairman Powell back on the Hill for another round of testimony, this time before the Senate. This afternoon, more retail earnings. Nordstrom and Gap report their latest results. Tomorrow, UK Prime Minister Theresa May will deliver a Brexit speech, and Sunday is election day in Italy. As we count down to Chairman Powell's second day on the Hill, Rick Reader of BlackRock weighing in on what Chairman Powell means for the markets. Take a listen.
Looks like we're just waiting. Right now, there's no good plays yet.
The last 2 to 3 years, 4 years, 5 years, actually, where the central banks were everything. It's every word, every piece of information that came from the central banks was everything that you had to focus on for investment. How much quantitative easing we're doing. That is changing. The world is moving more from monetary to fiscal policy. So while what he says is important, it's interesting. I think as we were alluding to, since he started talking, the equity market has gone down almost 3% on Tuesday after being up for a couple of days. So the markets are still tuned into it.
Bloomberg's Lisa Abramowitz joining us here in New York. Things changing?
Well, things are changing on the fundamental picture. You can see today with the jobless claims coming in at the lowest rate, or falling to the lowest rate in nearly half a century. People are looking at the backdrop and seeing a pretty good U.S. economy. The question is, does Jerome Powell see this as spurring inflation? And that'll be the big question today.
I think a lot of people asking the question whether the Federal Reserve is still the friend of financial markets. A lot of debt issuance is set to come to the market. Is credit still wide open for issuers just to come in?
It's interesting because there's been more investment grade.
See right here, where I'm drawing the line. It's kind of like supporting here, and it's not breaking over here.
That investors are demanding to own investment grade credit has been widening. You've got Bank of America, Ford, Mizuho all coming to market. It's clear that there is a little bit of indigestion, and the question is, will that only continue? How much will that be exacerbated as Jerome Powell does speak? And this is an area to watch. And certainly the Teva Pharmaceuticals deal, the $3.5 billion junk bond issuance, with a 10-year tranche with a yield of 7.5%.
Looks like once across here again.
It's real yield. It actually is. That's a plug for the show on a Friday as well. There we go. Tune into Bloomberg Radio as well with Bloomberg's Lisa.
It's not much of movement here though. It's my worry.
26 minutes into the session, this was the countdown to the Open. This is Bloomberg TV. It's Chairman Powell up next in front of the Senate Banking Committee.
Again, big part of this is just the waiting game. You get in at the right time. It's looking good here for Amazon on the 1 minute. 5 minute, not yet. See in about 20 seconds. Struggle right there. Alright, so it's trying to break down right now. Trying to hold it. Alright, so right here, it's just consolidating right now between the two. Not yet a good time. Not according to the 5-minute yet. A little curve here now though, just because of this, and then the histogram is trying to go back up here.
It is 10 a.m. in New York, 3 p.m. in London, and 11 p.m. in Hong Kong. From New York, I'm Bonnie Quinn.
And live from London, I'm Mark Barton. Welcome to Bloomberg Markets.
We'll start it up. This one's pretty good.
Fed Chairman Jerome Powell moved markets when he testified before the House Financial Services Committee Tuesday. Today, he's before the Senate Banking Committee. We'll bring you the question and answer session live. And we're expecting an announcement from the White House on steel and aluminum tariffs. We have our eyes peeled for that. But
Probably have to wait for the next 5-minute one.
Julie Hyman is here.
Yes, it's the Institute for Supply Management's manufacturing number coming in at 60.8. 58.7 was the estimate, so obviously better than estimated for this particular measure of manufacturing. I'm just looking to see if we know when it has been this high before. It looks like it is the fastest pace of expansion going back to May of 2004. So again, that index is 60.8. The employment gauge within it jumping to a 4-month high of 59.7. A measure of new orders at 64.2. That's an easing from 65.4 in January. And finally, the prices paid index. This is interesting. Rising to 74.2. That's the highest since May of 2011. So yet more evidence here of inflation within this particular report. As we look at stocks this morning, we are seeing a third straight day of declines for the major averages as we await the second day, although not the second consecutive day, of testimony from Jay Powell, the Fed chair. We're going to be listening into the question and answer session in a moment, but as we know, the other day when he spoke, the testimony was read as hawkish, and we saw an increase in rates and a decline in stock. So stock slightly softer going into the testimony today. We also have a lot of corporate news that we are watching as we get towards the end of earnings season. We've got some other news stories as well. Salesforce.com is an earnings story. That company in particular giving a revenue forecast that topped analyst estimates, so those shares rising. Technology continues to be strong. Newell Brands rising on a story in the New York Post. The Carl Icahn has recently bought a leading equity position in the company, so those shares up 2.5%. On the downside, we've got dental supply company Patterson Companies tumbling. Evercore ISI calling its earnings report a truly remarkable quarter for all the wrong reasons.
This is good right here. This is good that it's curving.
Terribly, and that only a tax benefit helped save what would have been an even uglier quarter. All of that according to Ross Muken over at Evercore ISI. Finally, Allergan falling as Mylan announces plans to align itself with a small cap competitor and develop a Botox biosimilar. So Allergan shares down on concerns over that. We also continue to have retail news in terms of earnings, so we're watching Best Buy and Kohl's on that front. Best Buy comparable sales in the fourth quarter rising 9%, well above estimates. Those shares hanging on to a gain, and Kohl's shares, which were earlier higher, have now turned lower as the company's comparable sales gains in November, December slow.
Alright, so this one right here
And finally, quick look at the Bloomberg here.
started above that line.
We're looking at the yield curve.
It's good.
And the twos in white.
Still trying to go above this a little bit better, but we have another 30 seconds till the next 5-minute candlestick starts, and that could really be our buy-in.
Of economic data beats, as we see, it's obviously not as dramatic as the narrowing of the yield curve, but something to continue to watch. Mark?
Julie, 90 minutes until the end of the Thursday equity session. We're down for a third day. Just one industry group rising today. Utilities, the other 18 are lower. 1.3% is the drop.
That's good, big increase there.
Biggest percentage drop since February the 9th. That was an interesting day. That was the day the
2 seconds.
fell to a 6-month low comes on
Started up high. It's good. A little red right there, but
since June 2016 it fell by 4%. Furley PP, the share's been hammered today. Thought I'd just put it in perspective by showing
a
you
little red.
chart.
It's my worry before I hit buy.
15% earlier, biggest drop since 1998. As of now, shares are down by 11%. The world's biggest advertising.
See, it hasn't crossed yet here, and it went red. Apple getting closer to 179 again. That's good. CVX, Chevron getting closer back to 113. We're good there.
2017, where revenue and profit margins were also flat. Look at WPP.
Oh, look at that.
Getting slaughtered today.
That's good.
Let's look at some of the data we've seen across Europe today. Euro area factory output continues to expand at a robust pace. Mounting signs, though,
I like that.
momentum may have peaked. We had a PMI for manufacturing falling to 58.6 in February, slightly better than a previous flash estimate of 58.5. The gauge has declined, though, since the end of 2017 was the steepest in 2 years, reinforced by a slowdown in export orders across the region. The reading is one of a cluster in the last week, suggesting exuberance over economic activity and trade may be cooling off, even as euro area and global growth remains strong. Just want to show you another stock that's in the news
A little more
today.
buyers at the
AMD
09.
rising by 3.4%, was up as much as 6% earlier, biggest increase since September 2015. The maker of Budweiser reporting stronger than expected fourth quarter
Good
revenue.
one right there.
Exports of Stella Artois and Corona. ABI, by the way, has beaten not only its beer industry rivals,
Ignore the dog. You may hear in the background.
Procter & Gamble, Bonnie, in average organic sales growth over the last 5 years. Shares today up by 3.4%.
All right, a little bit of a challenging start perhaps to the month, but we shall see. It is a long trading session. Fed Chairman Jerome Powell back on Capitol Hill today, meanwhile, following his market-moving performance Tuesday. Now, this time he's appearing before the Senate Banking Committee. Joining us now, Michael McKee,
Oh, red right here.
economics and policy correspondent, Ira Jersey, chief U.S. rate strategist for Bloomberg Intelligence, and also on Capitol Hill itself, we have Kevin Surley, Bloomberg's chief Washington correspondent. Michael, let me start with you. There was a market reaction, but nothing like we've seen in terms of a taper tantrum or anything like that in the past. I mean, there was some movement in treasuries and stocks, but we're back to where we were.
Well, we're back to where we were. We'll see whether Jay Powell meant what he said.
Chevron's back in the 113s, so that's great.
Do you really mean to suggest that we're going to see a faster pace of rate increases, maybe 4 moves this year, because you think the economy is growing faster? That's the bottom line question. It may not be for the senators, but it is for people on the street.
Ira, what will Jay Powell have learned from Tuesday's market reaction that he might try to undo or put into practice today?
Well, I think he actually did quite a good job. I mean, he stayed on message. He didn't say anything that was significantly different than what you saw in the minutes or the statement of the last FOMC meeting. So I think we didn't get a lot of new information from him. I think the fact that he sounded maybe a little bit more hawkish just surprised some people as opposed to it being significantly different. And I think also...
Red, this is why we wait for a better crossing there.
What is the word further? Like, what does further mean? Does it mean faster or does it mean longer? And I suspect it actually means longer. And the market's still not pricing for 3 hikes in 2019, which the Fed says, that they would like to do if everything turns out the way they think.
Kevin Surley on Capitol Hill. There's always a couple of senators that maybe are a little more colourful in this topic than others. Who are you looking for in terms of questioning?
Well, get ready, because senators walking in and out of the room behind me and outside of the Senate Banking Committee hearing room. I just spoke with Senator Richard Shelby, who said that, of course, the Republican, he said he's going to double down on what the House members were asking earlier this week about the timing of the rate hike. Now, of course, Fed Chair Powell saying that the economic confidence and how the economy has been moving has given him more confidence about the potential of another rate hike for this year. But on issues of regulatory reform,
8 seconds to the next 5 minutes.
We should note the backstory here, which is that Senate Banking Committee Chairman Mike Crapo is likely going to have a bill on the Senate floor early next week, he tells me,
started
regarding Dodd-Frank.
lower here, started lower here.
In terms of how they are going to regulate on a host of issues, on a host of rules rather, put forth by Dodd-Frank. that's where this could get interesting. We saw a little bit of that in the House hearing, but I would anticipate a lot of regulatory questions and follow-ups in this hearing that's about to get underway.
Mike, what stood out
It's curving pretty good.
Expressing his own view. Is that refreshing from a Fed watcher, a seasoned Fed watcher like yourself?
Well, it's odd, and the reason being is when they appear on Capitol Hill like this, they are supposed to be speaking for the entire committee. And I think that's what got a lot of traders' attention when Powell went beyond saying, we are looking at this, to, I think the economy is stronger than I had anticipated, and I'm going to have to adjust my forecast. Then people look at it and say, hey, the Fed chair is the center of gravity. They're the one who pushes everybody
Apple
in the direction they want to
struggling
go.
a little bit.
Things are better than they had forecast in December when they were talking about 3 increases. Maybe he's going to go for 4, and that helped lead the move in the bond and stock markets on Tuesday. So we'll see if he sticks to that formulation today or goes back to talking about we. And if he emphasizes the idea of we're going to have to look at the data, that might help him get climb down from his perch a little bit.
I think, I think another thing that it's important to realize here too is that Jerome Powell, not being an economist, I think handled himself pretty well for a non-economist, talking about a lot of economic,
here it's trying to curve it back up.
Environment and also his outlook. So I would like to see more of that today, but I agree that it's more likely to really focus on Dodd-Frank, how we're going to reform. Jay Powell said something very important in that regard on Tuesday, and that's that he sees the merger of both regulatory powers and monetary policy as being important for the Fed.
Ira, given that Powell spoke his own view, many have
Here it's looking like it wants to cross. Stochastic here is super low though.
Fall into line. Do we have a problem here, or can the rest of the FOMC state their views, but as Mike said, Powell's is the one that matters?
Yeah, well, I think that it's always been, or at least since Ben Bernanke took over, it's been, trying to create a consensus, but at the same time, everyone having slightly different views. Jerome Powell didn't really talk about that. His communication policy seemed to continue to extend what both Ben Bernanke and Janet Yellen had done during their tenure.
Kevin, just coming back to Tuesday, what do you think, or from what you've heard, how did the White House take the Fed chairman's first testimony to Congress?
They liked it. I was just speaking with a financial services source before coming on who noted that this pick, while yes, he doesn't necessarily have the traditional background that other folks and other Fed chairs have had, for the large part, he has been a consistent...
So right now it's, if you see right here, it's just been stuck in a consolidation the whole day so far, right? So what we could do is we could buy it at the bottom of a consolidation and then set up a stop loss right below it. So in case it were to drop, then we just take a small loss. But if in case it goes up, then we can sell at the top of the consolidation and then walk away with that money. So right now it's headed towards the bottom of it, but I want to get a better price in, closer to 14.97. I can.
And seems not to be carrying himself in a way that his successor did, at least on the way into hearings.
He is delivering his statement again now. It's usually the same.
See, my stop loss though would be like 14.94. $1 underneath it.
Since even Tuesday, we've had some new data, including this morning the
That's why I want to get a better price in.
PCE deflator, which is what the Fed, counts on, and things like initial jobless claims, which really were either as anticipated or
It's trying to bring it crossing back though. Stochastic's trying to help it.
It's amazing. The lowest jobless claims since 1969. I don't want to even guess how many years that was before you were born. It was a long time ago that we saw claims this way, and the labor market has grown a lot since then. So this is really remarkable. It shows you how tight the labor markets are. Raises that question about why we haven't seen wage increases move
Let's see
faster.
here.
But we'll see if that continues. Powell.
It's also like a bottom of a smaller consolidation, smaller channel.
Came in very strong today, suggesting that manufacturing is still going well. Big gains in export orders, which is something that should make the president happy and increase manufacturing because
Looks like it wants to cross here again. Stochastic trying to push it back up.
There's a song about the summer of that year, I believe,
Full green right there.
We kind of know that there are going to be tariffs imposed.
Yeah, so I think that really will that could affect the
Histogram here is still trying, but it's like slowly headed back.
We've had a more open and kind of global environment since we had NAFTA, the WTO, the GATT agreement, and all of those things in the 90s. So a pullback of that it's a little bit unclear what type of economic impact that will have. The United States is overwhelmingly a service economy as opposed to necessarily goods. So
No,
it's
staying on the 5-minute wants to keep going down. Wonder if it's gonna break down below the 97.
There'll be some retaliation on this too.
Yes, Michael?
Back in the early 2000s, George W. Bush put tariffs on, and they say they saved maybe 10,000 jobs or so in steel.
Doesn't look like today has been that good of a trading day, even for short selling and then not short selling. Not yet so far.
1.6 million people work in downstream steel and aluminum using industries, so there are knock-on effects. And as Ira said, price questions, very unclear here because, yes, steel prices will go up. Caterpillar tractors will get more expensive. Cars will get more expensive. Refrigerators, anything made with steel. But if China puts on tariffs on U.S. agricultural products, they'll get cheaper. We saw sorghum prices fall when China initiated an investigation into sorghum dumping after the president put on those solar panel tariffs. So we could see a sort of an offset there. Hard to say exactly how it affects inflation.
And Kevin Surley on Capitol Hill, let me ask you what's going to happen this week, because we have China's top emissary, you know, in the area of trade and, you know, those kinds of relations. Liu He in Washington today, in fact, even as President Trump is going
It doesn't look like today's good so far.
Yeah, so on the first point I'd raise,
Everything's just kind of staying where it's at because of Powell's testimony.
it gets more interesting. Canada,
We're all just waiting for it.
To trade importer to the United States with regards to steel. And of course, NAFTA talks nearing completion. You've got the TPP round in Chile about March 13th. China doesn't like this. The European Union doesn't like this. The beverage
So
industry
just
domestically
keep,
doesn't like this.
just
South Korea, which is
just
already
remember that
that they would ship business to
sometimes not trading in a day is better than trading and losing. So it's crossing again. Stochastic climbing. Here it looks like it's getting ready to cross, but the MAC and the histogram, well, the stochastic right here is kind of curving a little bit.
I don't know exactly because it depends on how the leader is able to manage the nominations that are now ahead of us. But I expect that sometime either Monday or Tuesday we will move to the first vote, which will probably be a cloture vote.
We should note that the Senate version of the Dodd-Frank regulatory relief package is very different and more moderate than what the House had passed several months ago. But if you're in the banking community, this is a giant step forward in terms of the legislative process, should it get floor time. Reg relief coming for community banks as early as next week.
Michael, on Tuesday I asked you what question you'd put to the new Fed chairman, and productivity was the area I know you were interested in, and Powell...
We have 1 more minute to the next 5 minutes, and we'll see if that helps cross it.
...to new Congress and Trump, which, you know, begs the question, will the fiscal reforms be enough to boost investment and improve productivity?
It's a key question, and it's one we may not get an answer to for quite some time. When he said over to you, Congress, I mean, the Congress has already passed the tax cuts that, in theory, would lead to increased investment in capital, which, in theory, would lead to faster productivity. It depends on how many companies invest and what they invest in, but it also takes time. There's something like $51 trillion worth of capital in the United States. So any kind of investments on the margin over months or a couple of years is going to take a long time to seep into the productivity numbers. And you're going to see inflation rise before you get to that. You're going to see faster growth and inflation before you get the productivity bump from that. What we may have to hope for is that it attracts more people into the labor force fairly quickly. Otherwise, inflation will be higher. Powell, as he says, can't affect really either one of those. That's a congressional thing. The train's going down the track. We'll see how long it takes to get there.
Ira, one of the criticisms of the Fed since the crisis has been that the tail...
This should cross already, but it's not. Alright, looks like the TV thing's kind of struggling with connecting. Look how long it's taking for it to try to cross.
In general, as to what their intention is, given a certain set of circumstances, means that the market anticipates that more. The Fed can take that away. I mean, Jerome Powell, if he wanted to say, hey, we're actually only going to do 3 hikes this year, he can come out and say that today, and the market would move. Will he say that? Probably not. One of the things that the Fed wants to do is keep all options open, but at the same time, not shock the market by making any crazy statements.
And Mike, just briefly, there is some disagreement within the White House on these tariffs, right? I mean, Wilbur Ross, the Commerce Secretary, is probably way more pro-tariffs than, people in maybe the State Department.
The State Department has actively been working against it, as have people in the Defense Department. They don't see the need. The administration is using this as a national security issue, and they don't see it yet.
All right. Let's get to the question and answer session. The Senate Banking Committee and Fed Chairman Jerome Powell.
Threshold from $50 billion to $250 billion and requires the Fed to tailor regulations to a bank's business model and risk profile. I'd like to ask you some questions about this bill if it does become law. And there's 5 or 6 of them, so I'd like to have you respond as briefly as you can, but fully answer the questions. Is it accurate that the Federal Reserve would still be required to conduct a supervisory stress test for any bank with total assets between $100 billion and $250 billion to ensure that it has enough capital to weather economic downturns?
Yes, it is.
And is it accurate that the Federal Reserve would still have sufficient authority to apply any prudential standard to a bank with between $100 billion and $250 billion in total assets if the Fed determined that was appropriate?
Yes, that is true.
Is it accurate that this provision does not weaken oversight of the largest globally systemic banks?
That is correct.
Is it accurate that the Federal Reserve applies enhanced standards to international banks based on their global total consolidated assets, meaning this provision would not exempt banks such as Deutsche Bank and Santander from Section 165 of Dodd-Frank?
That is correct.
Is it accurate that this provision does not in any way restrict the Fed's supervisory, regulatory, and enforcement authorities to ensure the safety and soundness of financial institutions?
Yes.
So it's kind of staying in the same place right now because it's listening to that. But here, on the 5 minutes, it's looking like it wants to cross here soon. So that's good. It's getting ready to do that a lot better.
As you know, the Dodd-Frank Act included a provision known as the Volcker Rule, which placed restrictions on banks that trade for their own profit, otherwise known as proprietary trading, and on certain relationships with certain private funds. As you also know, financial companies have incurred significant costs attempting to comply with the rule. Do you support addressing this confusion by exempting community banks with less than $10 billion in total assets and who are engaged in a small amount of trading activity?
I think that is a sensible thing to do, yes.
All right, thank you. And some have expressed concerns that this exemption would allow a community bank to purchase a hedge fund. Is it accurate that the Federal Reserve could use its existing authority to address any safety and soundness concerns arising from such an action?
We would still apply all of our safety and soundness supervisory activities to that bank, and we would be looking for things like that and find them.
All right, thank you. Finally, and I'm shifting gears away from the legislation right now, I also mentioned in my opening statement that Randy Quarles has been confirmed as Vice Chairman for Supervision of the Federal Reserve, but has not been confirmed for his full term as a governor yet. I believe it's very critical that we do that confirmation and confirm Governor Quarles for his full term. Do you agree? And if you do, why is it critical for the Senate?
10 seconds to the next 5 minutes.
As soon as possible.
Well, thank you for raising this, Senator, Mr. Chairman. I absolutely agree. It's very important.
It's crossing. It's trying to cross right now here.
It is full term.
This is good. This is good. This is good.
Governor term, but he has a 4-year chair term, and I
1 minute, decent. Ooh, looks like a little red, so it's not doing the crossing yet.
Thank you. I appreciate your emphasis on that, and hopefully that will help to encourage.
Let's hope we can go right above that.
To move more expeditiously on that nomination. Senator Brown.
Thank you. I appreciate
Right now,
friend and colleague.
it's kind of like right on the line right there.
Narrow and leading questions about his legislation. I think it's important to point out.
Alright, so in 5 minutes at 8:30, if we're not in, then I won't go in. I'm gonna set my cutoff then.
My question, I want to get to questions, but I also want to point out, in spite of this chair of the Federal Reserve general satisfaction with this bill, that there have been serious questions raised against it, raised about it by former Fed Chair Volcker, by former Fed Governor and Deputy Treasury Secretary Sarah Bloom Raskin, by Bush appointee, former FDIC Chair Sheila Bair, by former Consular of the Treasury Secretary Antonio Weiss, and by the former Deputy Governor
It's a better
Paul Tucker. I think it's important to note
confirmation right here.
it's not all candy and roses here. Let me talk about a couple other things. Unemployment rate's been steady, 4%, 4.1%. Wage growth, as you know, Ms. Chair, has been slow to improve. At your confirmation hearing in November, you mentioned that labor force participation for prime age workers was also lagging. I'd like to see improvement.
Looks like it's going green right now.
Two questions related to that.
It's
Do you think
good.
It's possible to achieve further improvement in wages and employment among workers that have been left behind?
It's good right there.
Causing higher inflation. And will you
Looks like it wants to move up now.
considering the workers who have struggled the most, so as to avoid raising rates preemptively and cutting off the chances for broader economic gains?
But you see right here though, this is a key point to watch these two little right here. We want to make sure that it goes above that. We don't want it to bounce down.
The biggest of those is that prime age participation by prime age workers is a full percentage point below where it was before the crisis. We don't see any strong evidence yet of a decisive move up in wages. We see wages by a couple of measures trending
previous
upward,
close.
most of them continuing to grow at about 2.5%. So nothing in that suggests to me that that wage inflation is at a point of acceleration, and so I would expect that some continued strengthening in the labor market can take place without causing inflation.
Started up higher here, so that's good.
They're much more two-sided than they were 2 or 3 years ago when there was a great deal of slack in the labor market.
And I appreciate, as I told you in person, your interest and commitment to both mandates of inflation and employment.
It is a good sign, but we need to wait.
May not, or may have the votes, may not
We
have the
need to
votes on
see
the floor.
it start higher than here.
Your position there is crucial, as Chair Yellen understood, as Chairman Bernanke understood. Second question, Morgan Stanley and other Wall Street analysts have said that only 13% of the reduced taxes under the tax
Apple's in the 179s again.
workers pay, 18% will
That's
go to
good.
mergers. If that ratio holds up for banks, 18% will go to mergers, 13% for worker pay. If that ratio holds up for banks, whether it's the tax bill or the chairman's bill he talked about, shouldn't we expect even more bank consolidation?
I guess first I'd say we don't really know yet how that will shake out, but taking your hypothetical, would it add to more
Okay, so we got about 50 seconds to the next 5 minutes starts, and that could be our buy-in. It's starting pretty good here. It's like trying to cross that line right now. So if it can start above it, perfect.
This would tend to change the trend.
Yeah, I appreciate what you just said, because I certainly heard the deregulators in this body, those that suffer this collective amnesia.
The market's starting to like what they're talking about.
Blaming bank consolidation on Dodd-Frank, when, as you point out, it's been going on for years. Mr. Chairman, I'd like to. Here's an American Banker article from November that discusses your bill. The title is "SIFI Hike Could Kickstart Bank M&A," and I asked to enter that in the record.
Without objection.
Thank you. Last question. Most of the
Jones just went green. Started up higher here. Started above that line there.
have been repeat offenders since the crisis. The Fed and other regulators have fined them. You were part of this. $240 billion in combined penalties, money laundering, market manipulation, deceiving customers, you name it. The chairman's bank deregulation bill would mandate that the Fed
red right there.
For the largest banks. Meanwhile, Vice Chair Quarles is talking about the Fed's plans to make living wills less frequent, to reduce leverage rules, to weaken the Volcker rule. Why should big banks that have failed to follow the rules benefit from statutory or regulatory rollbacks?
Pretty sure I'm gonna have to change it though.
Our focus is very much on the smaller and medium-sized banks. We want the post-crisis regulatory initiatives like higher capital, higher liquidity, stress testing, resolution. We want those to apply in their strongest form to the largest institutions. We want to make sure we're doing that efficiently, and there are some changes we can make in that regard. But most of what we're doing really applies to banks that can move down.
I sat with Senator Crapo and a number of others that are in this room.
See if it gets me in at the 11. Okay, it did. It went a little bit red right now. After I win, of course. Looks like I could have gone in at the 15-10. Went down a little bit. 5 minutes telling me to be in though.
So I hear your talk about your interest primarily is the smaller banks, but I guess the question still stands. Why should anything in this bill, why should we do anything for the largest banks as this bill does? Why should we do anything for banks that have consistently failed to follow the rules? Why should they benefit from statutory and regulatory rules rollback?
You know, as I see the parts of the bill that I'm familiar with, they really apply to banks 250 and under. And I think of when you say largest banks, I think you're talking
a little
about
struggle right now though.
SIFIs, by the way, one of which is below 250 billion in assets. So we're very capable of reaching below 250 to apply enhanced prudential standards when it's appropriate. But it's really those institutions that I would call the large and complex institutions, and the focus there again is on sustaining the 4 pillars that I mentioned of post-crisis regulation, and maybe looking at making them more efficient. They don't need to be more. They should
But it'll be okay. Green right here.
Strengthen and hold on to those.
Well, I hope in your conversations with the chair of supervision, Mr. Quarles, that you will insist that this is about the banks under 250 and insist on that it's not about the banks over 250, as some on this podium have suggested.
It's about to cross that. That's good. Started up higher on the 1 minute, so that's great. A little red though.
Chairman Powell, you referred to price stability just a few minutes ago as one of the mandates for the Fed in your job. Let's talk a little about price stability and
A little struggle again, just barely.
real low prices. You mentioned earlier that inflation is, I assume, under control, whatever that is.
See, the price is kind of consolidating as the stochastic is going down. So this may be in our favor to help bounce it back up here very shortly.
Incremental levels in the future. Is that because of your concern about the specter of inflation? That being full employment, so to speak, most pressure on wages? Or where's it coming from, in other words, or is it all of it?
Senator, so where we are now is we've got unemployment, as you know, at 4.1%, which is sort of at or near or even below most estimates of the natural rate of unemployment.
Buyers are trying to push it up, so that's good.
So by continuing to gradually raise interest rates over time, we're trying to balance those two things and achieve inflation moving up to
We got about 25 seconds. With this 5-minute one that we were under, it didn't really move much.
That's really the path that we've been on.
So it really needs to move it right now.
As long as the economy performs this way.
Well, I think that's a substantive path too. I agree with you.
5 seconds.
Do you believe that there's going to be a push for higher wages? You see a little of it.
This is good.
The economy's good. People seem to be doing well. The tax cuts come in, which is is going to help. We see it's going to help at least confidence and everything in the economy. What do you see there?
It's interesting. Unemployment has declined from 10% at the worst part of the crisis, and actually well after the crisis, down to 4.1% now. And wages have only really gradually started to track up. The increases are now up at about 2.5% if you blend the various measures we look at. We look at a bunch of them. And I'll be honest, I would have thought that you'd see more wage increases.
Chevron getting closer to 114. Apple trying to make its way to 180. So that's good.
We've got strong job creation as a result of it. We've got
Here you can see that Amazon just went green above the previous close line that I have posted up. So that's great. Started up higher. Wonderful.
Price stability.
Price stability is one of our two mandates. It's very hard at what we do. Absolutely very hard at what we do.
I'd like to switch over to your other job, and that is dealing with regulatory issues. Cost-benefit analysis unit. It's my understanding that the Fed has announced recently its intention to create what they call a policy effectiveness and assessment unit to conduct cost-benefit.
Buyers are still trying to help move it up higher, so this is good. It is struggling a little bit. That's okay.
A real cost-benefit analysis to every regulation. What's the status of this group's development, Mr. Chairman, and what do you hope that will come out of this?
As you know, Senator, we always try to implement regs in the regulations in the way that's least burdensome and also
did start up a little bit lower, so that's a little bit
we're trying to raise our game.
not the best, but it's trying.
Quantitatively oriented people who are focusing just on that. We have lately published cost-benefit analysis on specific regulations like the SIFI surcharge, long-term debt, and things like that. So, we're trying to raise our game here. By the way, whenever we go out for comment on a reg, we also ask for the public's views on costs and benefits. So it's really important to us. And as I said, as you pointed out, we're trying to raise our game.
A lot of it, though, is letting the public know what all of this is about and what the cost will be, and to them as well as to them.
A little red, but that's okay.
It is, and that is our obligation, is to be transparent about those things.
Thank you. Thank you, Mr. Chairman.
Thank you. Senator Tester.
Yeah, thank you, Mr. Chairman. Thank you, Member Brown. I appreciate you having this hearing, and welcome, Governor Powell. It's great to have you here. There has been a perception being floated.
It started a little bit lower again right here.
Foreign banking organizations such as Barclays, UBS, Deutsche Bank's been talked about today already, will be released from enhanced prudential standards.
It's crossing here on the MACD to go down a little bit.
2155. I fundamentally disagree with that. I think it's those views are myth.
Stochastic is kind of really low though, so this is still okay.
But I'm a dirt farmer, okay? I just kind of read things as they are and don't read a lot of extra stuff into it. You're the man on the Fed, and so I need to know your opinion. Does 2155 require the Federal Reserve to weaken any of the Dodd-Frank enhanced prudential standards for the FBO, such as Deutsche Bank, UBS, or Barclays?
It does not, according to my reading of the text.
Can you elaborate briefly, if possible, on how those standards are applied to the largest FBOs?
Well, currently,
5 minutes still decent, besides the stochastic went down just a little bit right here. It's curving. So I'm still not worried. And the stochastic on the 1 minute is getting ready to touch the 20, so it could really help move it back up. So that's okay.
Keep capital and liquidity here in the United States it's commensurate with their activities. They're also subject to living wills and things like that. So it's a range of enhanced prudential standards. The intermediate holding.
Yeah, we're just fine on there.
That we gave them.
Okay. Thank you. I'm also frustrated that some are jumping to conclusions about how or what might happen regarding international holding company requirements. So just to clarify, from your perspective, the creation of the IHS was not included in Dodd-Frank, correct?
TV struggling again a little bit. See here, it's trying to curve it back up on a stochastic. So this crossing that it did, it's trying not to hold it. Another green one here, so still good there.
Overwhelming bipartisan support, and hopefully we'll see the floor next week. And what I asked you at that juncture was, do you believe 2155 puts our financial system at risk? At that moment in time, you said no. So now you've had a little more time, get your feet on the ground. Do you continue to believe that?
I do.
Okay, lastly, go ahead.
I can elaborate if you want.
Sure, have at it.
Okay. So, you know, the essence, probably the most significant piece of it is that you raised the threshold for enhanced prudential standards to 250, but you give us the ability to look below 250. We will publish a framework that addresses, and we'll put it out for comment, that addresses how we'll think about that. We have not been shy about reaching below 250.
This is still good.
One of the 8 SIFIs, in fact, is below
We're still doing good
in assets. So I think it gives us the tools that we need to continue to protect financial stability.
Thank you. Lastly, I think it's important for folks to remember that the Federal Reserve and Chairman Powell have a number of tools in their toolbox when it comes to regulating our financial institutions, well beyond that, what we even created in Dodd-Frank. I think it's important to remember that things like advanced approaches, CCAR, Basel, weren't created by Dodd-Frank. And if I'm not mistaken, advanced approaches and CCAR were put in place in the Republican administration. So I guess my question for you, Chairman Powell, is this. Can you remind folks what your Safety and Soundness Authority means to the Federal Reserve, and what that authority it gives to you?
It gives us broad authority to, except in places where Congress has addressed.
Everything's still looking great.
Not
worried there at all.
Do capital requirements and of various kinds, liquidity requirements and things like that, and look after the safety and soundness of all depository institutions.
Thank you. I just want to close with saying that I don't for a second think that Dodd-Frank was the only reason we're seeing consolidation in banking. I think technology plays a big role in that, and population shifting plays a big role in it. On this committee, I can deal with Dodd-Frank. Thank you, Mr. Chairman.
Thank you, Senator.
It's really trying to still climb up. So
welcome, Mr. Chairman. It's good to have you here. Congratulations on your confirmation. You talked about the accommodative fiscal policy that's in place right now, and just out of curiosity, I know there's
a little struggle here at the that it dropped a little bit, but
you're definitely going to raise rates some. How much did the tax bill? Is the tax bill?
Apple going down a little bit, still above 179, but struggling a little bit.
Affecting your desire to or your likelihood of raising rates over this year?
I wouldn't single it out, Senator. I would say
I'm not trying to single it out, but just out of curiosity, it is in fact something that is going to be stimulative. So how much of a factor is it in looking at raising rates?
You know, fiscal policy is one of many factors. We're looking, as you know, we're looking at stable prices, maximum employment. That's what we're looking at, and everything that happens in the economy and financial conditions and fiscal policy affects that. We can't really isolate one thing, like fiscal policy, but I think, I would expect that fiscal policy this year is going to add meaningfully to demand, and that's going to put upward pressure on inflation and downward pressure on unemployment. It's hard to quantify, but it wouldn't be the main factor. I mean, the economy's strong, and it's even stronger now.
Yeah. So then, as it relates to growth, you said it was going to increase demand.
A little bit green back up again right there, so that's good.
In your growth projections, the passage of the tax legislation.
As I mentioned, I think it will add meaningfully to growth for at least the next couple of years. The real question is, how much will it add to, and the amount of that is subject to very different estimates by different approaches. But I guess the bigger question is how much will it add to longer run growth? And there are a couple channels through which that might happen. Higher investment should lead to higher productivity, which would raise potential growth. Lower tax rates on individuals should increase labor supply. These are highly uncertain, but we hope the effects are meaningful there as well.
Mm-hmm. You know, we've been through a decade now, I guess, since the crisis, and many of us were here during that time. It was a pretty heady time trying to resolve those issues, and yet we went through periods of time when we were worried about deflation. Obviously, we had really accommodative monetary policy during that time, and here we are again at 4.1%.
All red, but it's kind of consolidating a little bit right there.
And yet still, let's face it, I mean, 2% inflation. I know y'all are combating anything getting out of control.
5 minutes, kind of struggling a little bit, but
in this economy, in this world situation, what is it that is keeping inflation at such a low rate?
It's a global phenomenon, and we don't perfectly understand it, but I would say since the crisis, a big factor that's been weighing down on inflation has been just the weakness in the economy. You've had a lot of slack, and the economy has not been tight, and so that it makes sense that would press downward on inflation.
Alright, a little bit more green right now.
And lower oil prices in 14 and 15, that pushed down. So more lately, we would have expected inflation to come up by a few.
It's trying to curve a little bit here, but it's struggling too.
Factors. There are other stories, though. There's the Amazon effect story. There's global slack. The idea that slack around the world is affecting the tightness of the U.S. labor market. Really hard to tie those down from an empirical standpoint, but that may be having some sort of an effect on inflation as well. It is a global phenomenon, though, so it's not just tied to domestic factors.
So I know that my friends on the other side tend to focus a lot on the tax bill.
Starting to struggle a little bit more. Stochastic on the 1 minute is so low, though.
$2 trillion more that we don't have by passing the bill we just passed. We've got an omnibus coming up over the next 10 years. It's a minimum
5 minutes struggling.
in additional spending, almost twice what the president requested, and we have $21 trillion in debt today. How much does the deficit picture for our country come into play relative to the Federal Reserve, and how concerning is it to you that we continue just to party like there's no time ending here in Congress?
We're not on a sustainable fiscal path. We need to get on one. This is a good time to be doing that when the economy is strong, but that's a longer run problem. It isn't really
Apple dropped below 179.
Today's monetary policy or economy, it becomes a problem gradually over time.
The Dow is still up, but only by like 39 points.
Expenditures on interest rate, on debt service, and we have less and less to do the things that we really need to do, and as we pass along bills to future generations. But the unsustainability of our fiscal path isn't something that has too much of an effect in the near term on our policies.
Thank you, Mr. Chairman. Thank you.
Senator Menendez.
Thank you, Mr. Chairman. Welcome, Chairman Powell. Good to see you. I want to follow up on some questions that my colleague, Senator Brown-Kelby, asked you about. Inflation is continuing to run below the Fed's 2% target, which has prompted the majority of regional Federal Reserve Bank presidents to urge a study of the current inflation framework. And while we have seen significant economic gains since the worst days of the recession, most hardworking families are still waiting to see their paychecks rise. Real median wages increased by only 14% from 1979 to 2017, and any recent acceleration in wages is accruing to high-paid executives.
A little green right there, so that's good. Stochastic on the 1 minute, really trying to turn around to go back up.
Projecting a minimum of 3 interest rate increases in 2018, and after your testimony on Tuesday, the markets are now anticipating as many as 4 hikes. Do you agree that the achievement of full employment should be associated with strong and broad-based wage growth for average workers, not just increases for executives and managerial pay?
I do, Senator.
And if so, doesn't that argue for consideration of a monetary policy path that would allow wages to continue to grow prior to the Fed's pumping the brakes?
I agree that it does, and I believe that is in fact the path we're on. These are gradual rate increases, and we do expect wages to move up.
What would the cost to the economy overshooting inflation in the 2 to 3%
It's a little bit
range
red on
could
this one. They
cost the
just started.
economy of choking off growth if the Fed continues to tighten without a clear indication that inflation is going to exceed its target, B?
The risk, one of the risks we're trying to avoid, I think, as I mentioned earlier, the risks are more balanced than they used to be. For many years, it was clear there was a lot of slack in the economy, and, I, for one, supported accommodative policy. At this point, we have 4.1% unemployment, and the thing we don't want to avoid in that we don't want to have happen is to get behind the curve, have inflation move up, and have to raise rates too quickly, cause a recession. And recessions, they hit the most vulnerable groups, the hardest. And so that's where unemployment goes up the fastest and that kind of thing. So to prolong the recovery, the committee's view is that we should continue on this gradual path of rate increases, which balances lower inflation and low wages against the need to make sure that we don't run too far past the natural rate of unemployment.
Mm-hmm. Well, I hope you'll continue to look at wage growth as part of your calibrations. Let me ask you this. During the confirmation here, and I was pleased to vote for you, I asked you about the economic risks of adding an additional $1.5 trillion to the deficit. And I just heard your responses to my colleague from Tennessee that we're not on a sustainable path. We need to get one. Obviously, we weren't on the sustainable path before we added $1.5 trillion to the debt in the tax cuts that were
A little struggle right now, but
and you then said in response, and I quote, I think we need to be concerned with fiscal sustainability over the long term. And in the same hearing, you agreed with Senator Van Hollen when he asked you said adding $1.5 trillion to the deficit would make a bad situation worse. Now, your predecessor previously testified before this committee when she said, quote, I'm personally concerned about the U.S. debt situation. Taking what is already a significant problem and making it worse is a concern to me. Do you agree with former Chairman Yellen that there's reason to be concerned about mounting deficits and growing national debt?
I do, and I'll follow what my predecessors have done and not get too much into the details of fiscal policy, but I will say a couple of things. One is that, as I mentioned, we need to get on a sustainable fiscal path in the longer run. We know that we're not in the longer run. Second thing is when we do fiscal policy, when you do fiscal policy, I think it's important to keep in mind measures that would increase the productive capacity of the United States, of the economy, things that would increase productivity, that foster investment in people, in education and training, in R&D, and in plant equipment as well. Those kinds of policies can help the whole economy grow faster on a sustainable basis.
I agree with you. It's just that stock buybacks don't quite do that. Let me ask you a last question. In January, the New York Federal Reserve Bank president said that tax legislation is likely to generate frictional costs that will mitigate
little struggle on the
namely disparate impacts regionally.
5-minute right here. Stochastic is kind of low.
The state and local income and property tax deduction, which would raise the cost of ownership and adversely affect
I'm getting lower anyways.
activity in states like New Jersey. Do you agree with President Dudley's analysis that states like New Jersey will see regional economic disparities as a result of the tax bill?
Senator, I hope you'll allow me to say that I'd rather not get into the particular details of any particular fiscal bill as chairman, and I think I'm happy to talk about things at a high level, but getting into commenting on particular sections in a fiscal bill, which is not our responsibility for me, is probably not a good idea.
Your president of the New York Reserve made that observation, so I would hope that we would look at
here it's trying to curve to go back up, so that's good for us. And it really didn't go down too much, so we're just fine.
20-25% of GDP for the entire nation. If we're going to have policies that ultimately affect the ability to do that.
As you can see here, bottomed out, then it kind of bottomed out here, here,
Thank you, Mr. Chairman, and
here. It did over here too, but it's going to try to come back up to it.
I'm sure you have them all circled in your calendar. Look forward to the eagerness as a child does to Christmas, right?
Indeed.
I will talk about the labor market, in particular wage growth for America's workers. An article in the Harvard Business Review last October discussed wage trends since the 1970s and found that wage gains have
mostly accrue to top earners, while wages have declined or been stagnant for the bottom half of the income distribution. The bottom half of the income distribution is comprised of many Americans who don't have a four-year degree.
It's about to finish its consolidation, looks like.
Research from the Economic Policy Institute shows that American workers without a high school education have seen their wages decline by 17% since 1979, adjusted for inflation. And for workers with a high school education but no college, wages have declined by 2%. The chart to my left displays this, shows what I'm talking about. You can see the massive wage growth for those with a college degree or advanced degree, and wage declines in real terms for those with a high school degree or less. One of my top priorities is to ensure that hardworking Arkansans can share in the economic prosperity that we see in our country in ways that they have not over the course of my lifetime. Mr. Chairman, you write, I should say the entire board writes on page 2 and 3 of the Monetary Policy Report, although there is no way to know with precision, the labor market appears to be near or a little beyond full employment at present.
So it's kind of struggling with the stochastic a little bit right here. It's trying to decide what it wants to do.
You know, as we say in our statement of longer run goals,
And decided to go down a little bit.
look at a number of, there's no place you can directly observe it, so we look at a range of indicators. And I would say most of those indicators say that we're either at or beyond full employment. There are a couple that suggest maybe we're not. I would point to wages, and I'd point to labor force participation by prime age males. This is a long answer. It's hard to give a really clear answer, but we don't actually know precisely where full employment is. Put it all in the blender, it seems to me we're very close to full employment.
Yeah. To pick up on your
I would add, that isn't the case in every region.
To pick up on your point about labor force
It's going down a little bit more. Looks like it wants to cross on the 5-minute pretty soon, but I'm going to hold on.
It is somewhat surprising, given those economic conditions, that over the last year, labor force participation continued to decline from 62.9% in January of 2017 to 62.7% in January of 2018. Even if you account for demographic change, for the aging of the baby boom generation, many estimates say that 2 million workers are still missing from our economy. I also would note that job growth continues to exceed population growth, which suggests that there's still slack in the labor market. And a lot of this slack appears to be in part on the lower end of the economic scale of those workers who have a high school degree or less than that. Would you agree with
They're
that
struggling a little bit more.
Generally,
It's actually
yes. We are
pretty good drop since we've gone in, but
participation has been essentially flat since the back half of 2013, so a little more than 4
it's
years.
okay.
And the downward trend might be 25
I'm going to be
basis points
staying
a year.
in.
So I look at us as having made up probably the slack that emerged, fully made up the slack that emerged as part of the crisis.
And the wage growth we've seen over the last year, while good, I would suggest it's still not good enough, especially as long as we have those missing workers. So I'd hate to see, putting aside all the other reasons why you might see rate increases in the coming months ahead, rate increases because of continued increases in wages, especially for working class Americans. And the labor market, like any other market, is a market that's driven by supply and demand, correct?
Yes.
So if the supply of labor exceeds the demand of labor, then you'd see downward pressure on wages. That's one reason why I and some other senators, like Senator Perdue, have been focused on our immigration system. If you could magically convert 1 million high school graduates in this country to 1 million Stanford graduates that could go to work in our high-tech industry, then presumably that would be good for the wages of working-class Americans. Well, that's essentially what we do every single year, is that in reverse, is we bring in 1 million unskilled and low-skilled workers that are competing against the very people who have not shared in prosperity, and for that matter, competing against the previous generation of immigrants. I don't think that's good for American citizens. I don't think that's good for our economy. And we'll continue to work hard to make sure that those workers can share in the prosperity that all Americans in the upper income brackets and college-educated and more have shared in the past. Thank you.
So hitting $1,500 even.
Thank you, Chairman. Thank you for being here. Thank you for being
A little bit more sellers.
I want to talk about student loan debt. There is currently $1.4 trillion in outstanding student loan debt highest category of consumer debt behind mortgages. It's also the most delinquent, with 11% of borrowers seriously delinquent or in default. The Fed estimates that this number is likely closer to 22% once you take into account the number of borrowers who are in forbearance. In contrast, at the height of the financial crisis, mortgage delinquency was just under 5%, and currently that rate is
this downtrend won't hold much more. Lower here.
Have contributed to lower rates of homeownership and
Low.
business.
So I'll help move it up pretty soon. So I'm gonna keep it here, guys. I'm holding on to my position. It's gonna try to start climbing again. But I am gonna hold on to my position. If it goes up throughout the day to like 520, 525, well, 1520, 1525, I'll sell about that. I'll look at it for tomorrow as well if I'm not out today, because I do think it will hit that price within the next couple days, latest Monday. So I am going to hold it, and I am going to end the stream here. You all have a great day, and I will see you all on Monday morning when I start my live stream again, because tomorrow I won't be streaming. But have a great day. See you guys soon.